right place. So my name is Debbie McCutsky, and I'm the coordinator of services and programs for Graduate Student Legal Aid. I use she, her pronouns. Today's workshop is the first of 9 workshops in the spring Gradulting workshop series. This series is just one of several services offered by Graduate Student Legal Aid. So what does legal aid do? Legal consultations for general issues such as tenant-landlord disputes, auto accidents, contract reviews, and much, much more. Our attorney, Zach Mundy, is meeting with students virtually, and if he can't help you, he will make a referral to someone else who can. So we also do legal consultations on immigration issues. So if you're an international student and you're not sure how to handle some immigration issues, schedule an appointment with our attorney. We have advocacy services for students who are charged by the Office of Student Conduct for a violation of the Code of Conduct or the Code of Academic Integrity. I am a notary, so I can help you. It doesn't matter if it's a personal document or an academic document. I will notarize pretty much anything for you. And all of our services are free. So visit our website. Cody, our grad student, is going to put the link into the chat. And there's information about our services, how to request an appointment, and there's a resource page with lots and lots of information. So I hope you can take a look at that. All right, just a few announcements before we get started. Automatic closed captioning has been enabled for those who want to read along. And of course, we welcome your questions and comments, so post them in the chat and direct them to everyone. Near the end of the workshop, we will post a link to a survey. We only ask a few questions, but your feedback is really important, so please take a few minutes to do that. And finally, we will email links to the survey, the slides, and the recording for this workshop by tomorrow afternoon. It'll probably happen before then, but that's the plan. So let's get started with the topic of the day, investing on a tight budget. I am pleased to introduce our speaker, Rachel Sayad. And Rachel is a financial advisor and the college unit director for Northwestern Mutual. Northwestern Mutual, for those of you who've never heard of it, it's an American financial services mutual organization based in Milwaukee. So, Rachel, welcome to the workshop series. Tell us more about yourself and tell us how we can help build our wealth.
Perfect. Thank you so much, Debbie. As I was sharing with Debbie before, everybody, if you would like to turn your camera on, if you would like to come off mute, please feel free to do that. I'm going to share a bunch of slides. I'm going to go in and out of sharing PDFs. So please stop and interject if you have questions. That is welcome. I'd like to make this as interactive as possible. If you do have questions and you just want to put them in the chat, that's fine too. Debbie's going to help me go through them. So as she just shared, I'm a financial planner for Northwestern Mutual. I've been doing this for 6 years. I came right out of college. I went to Washington College. It's a really small school, liberal arts school on the Eastern Shore. And I'm going to talk a little bit about, like Debbie was talking about, our budget. We're going to talk through investing and just ways to make good money decisions. I was actually an English major at Washington College, so I did not come from financial planning background. So those of you who are studying finance, financial planning, this is going to be really awesome for you. And those of you who are not, don't feel like this is not something that's going to make sense, because I'm going to try to make it as relatable as possible. The second thing I'm going to share is we're going to go through a bunch of slides and just ways to think smarter, but I'm going to talk to you guys like I talk to my clients. I have a lot of different clients in different age brackets, demographics, and everybody, whether they're in their 20s or their 50s, I really talk to them the same way about money. and I talk to them the same way about investing. So we're going to hop in here in a second and get into the slides. And like I said, please interject or ask questions. The more interactive we can make this, the more fun it will be for everybody. And let me share this. Debbie, tell me if you can see what I'm sharing. Let's do this. There we go. Okay. Can everybody see this?
Yep, looks great.
Awesome. Let me move this box out of the way here. Okay, awesome. So kind of a question that I just like to pose to everybody, and you don't have to come off mute, or you can write in the chat. I would love to know if you feel open to sharing. How many of you do you feel currently have a plan in place to reach your financial goals? Whenever I chat with a client, or I share this with somebody, or I ask this question the first time I meet them, a lot of the answers we get are, well, I've set up this or I've set up that, but they don't necessarily have a plan. And there's a huge difference of just doing one particular thing, whether it's investing or they set up a savings account or they have this or they have that, versus having a full financial plan. So I would love to have you guys think about what that actually means. So this is kind of a crazy statistic, but 1 in 4 people have stated that the number one roadblock to financial planning was the lack of time. And I always share with people the reason why people don't do these things is because it takes time to go and figure them out and do the research on their own, which is why I have a job and why I do what I do. Another question I would like you guys to think about is what's involved in creating financial security? What does that actually mean? Everybody has a different answer when they think about this. And I always ask clients, what does financial security mean to you? What does money mean to you? And as you all could imagine, if I asked you guys that question, that means something different to everybody, which is really cool. So there's really 5 actions that make up financial security. And I know we're here to talk about investing and investing on a tight budget. I'm going to get to different pieces where we go through that, but I want you guys to think about investing is just one piece of a financial plan. There's many pieces that make up a plan, and investing is one small piece. So I would like you guys to think about these 5 areas are how we make sure that we have a financially secure plan and that it's going to weather all storms. And I know you all can read the difference between saving, spending, growing, protecting, and giving. We're going to talk a lot about saving and growing today. And everything we go over today, I'm going to send to Debbie so she can share with all of you, and happy to connect with anybody offline about these things after today. So one of the main things I talk about with clients, there's 2 real big factors that comes when we talk about saving and we talk about investing. There's 2 things we want to think about. So if you guys are jotting down notes or you want to write down something, the 2 things I would share are we want to make sure we have an emergency fund built. And the goal before we even think about investing is to have 3 to 6 months of our bills saved up in cash. That's really, really important. I really discourage people. Does somebody have a question? Oh, somebody was coming in. I really discourage people to invest if they do not have an emergency fund. And a couple of you might think, well, why is that the case? Well, that's the case because when we invest money in the market, there is, of course, market volatility. We don't know if that dollar amount is going to go up or if it's going to go down. Of course, we hope it goes up, but we have to have that emergency fund built. So that's number 1. Number 2 is we want to try to follow the metric of the 60-20-20 rule. We're going to talk about that in a moment, but that's referring to 60% of our bills go to, 60% of our money that comes in goes to bills, 20% goes to saving and investing, and 20% goes to fund money. We're going to talk about the saving and investing category here in a minute, but I want you guys to write down those 2 things, 60-20-20 and 3 to 6 months of our bills in cash. Any questions so far? Raise your hand, you can write in the chat. Awesome. All right, we're going to skip over a couple of things here. All right, so kind of like I was just referring to, we want to make sure that 20% of our income goes away to saving and investing. And you have to think about your goals in terms of what are the short-term goals, what are the midterm goals, and what are the long-term goals. So I'm going to switch screens here for a second, and I'm going to share with you all the budget that I go through with clients, and I'm going to share with you the piece I share when it comes to saving and investing, and where we should do that based on two things: time horizon and taxes. Get out this real quick, we'll come back. All right, so this is the budget that I use with all of my clients. Let's do this. And I think it's really helpful because I know you guys can read on here. Let me zoom out for a second. There's 3 different sections that make this up. And I want you guys to think about the top portion of our budget. And this goes for anybody that's in school, anybody that's in grad school, anybody that's working and getting out into the real world. This is something that no matter what you do, you should start with this first. You really have to have a clear idea of what's coming in and what's going out. And so at the very top of this budget, zoom in, this is where you're going to fill in all of your fixed expenses, your mortgage, your rent, your cell phone bill, any student loan payments, your car payment. All of those things need to go up here at the top. Then down here at the bottom, discretionary is anything that we spend money on that's extra. So our monthly subscriptions, dining out, shopping, all these things in this category in the orange are the extras. And then down here in this green section are really anything that goes towards our saving or our investing. And I do try to help people include what's going into a 401k and what's going into other vehicles. So as we think through the next couple pieces I'm going to go through, the 60-20-20 rule really applies. And then of course down here where it says net monthly income, that's where we're going to plug in what we're bringing home every month based on how often we get paid. All right, I'm going to go through the piece in a second. Any questions on this? I want to take a quick time out. Any questions on this budget? I will send this to you guys so you have it. This is a great tool to use, but anything that's coming to mind so far? All right, awesome. Okay, so I want you guys to think about, this says retirement planning considerations, but I want you guys to think about there's different places that money can fall. And there's really 4 buckets of money that we look at. We look at pre-tax funding and we look at after tax. So this is going to encompass 3 things. It's going to encompass cash, it's going to encompass investments, and it's going to encompass life insurance. So I'm going to talk about all these different places. Please write questions in the chat, or if you don't know what a word means, please stop me. I'm going to draw on this as well. Okay, so when we talk about pre-tax funding, a lot of you are going to get out of school and you're going to accept a job and you're going to get a benefit package. And they're going to say something like, you either have an option to set up a 401k or you're going to have something called a 403b. It depends on what type of job you get into. And when you see the word traditional 401k, what that means is money goes in pre-tax. And so when you get paid, money goes from your paycheck into this 401k, and they do not take tax out up front. So that's why it's called pre-tax. While the money grows over your lifetime, you're going to not pay taxes on the growth of that money. So the money is invested in the stock market, but we're making sure that the money is not getting taxed every year. So by the time you take money out of this account in retirement, that's when the IRS starts to tax you. They tax you later down the road. The difference between a traditional 401k and a traditional IRA, does anybody know the difference between those 2 types of accounts? They work the same with taxes, but there's a difference of why someone might have one over the other. Anybody want to take a stab? It's okay if not. Any brave souls? Okay, so the difference is that an IRA stands for an individual retirement account. What that means is it has nothing to do with your employer. It's your own account. So you can set up an IRA on your own. You can go to fidelity.com, you can go to vanguard.com, or you can set one up with an advisor like myself. And I'm going to talk about different platforms in a second where you can go and invest. So that's the difference of an IRA. A 401k has to be at your job. You cannot set up a 401k if you do not work for an employer that does not give you one. The difference is that an IRA, erase this real quick. An IRA gives us a couple things. It gives you the ability to access money out of that account for a couple reasons, and you can always access your cost basis, meaning the money that you've put into that account. The other thing we have to consider is that the IRS caps us on how much we can contribute. So we can only put in $6,000 per person per year into that account. It's helpful because if you need money for a first home purchase, or if you're going back to grad school or going to school somewhere else, and you guys are mostly in grad school, you can use that money for those reasons and not get taxed and not get a penalty. A 401k at work, you cannot use the money in the same way. And the idea behind this is that the money is growing in the stock market and it's invested pretty aggressively. So we're going to look at what that means here in a moment. Any after-tax funding, you can have a Roth IRA or you can have a Roth 401k. So what that means is that the money is taxed today. You do not pay taxes on the growth. And then in the long term, when you take the money out, you do not pay taxes in retirement, which is really important. So anything in the pre-tax is going to tax you later. Anything in the Roth is going to tax you right now. All right. Those are longer term vehicles. More of the shorter term vehicles is anything that we consider what's called a mutual fund, any stocks, or any bonds. And a lot of people just think about, well, I'm going to go open a brokerage account and I'm going to open it on Fidelity, or I'm going to open it on Robinhood, or I'm going to go to one of these brokerage platforms. And there's nothing wrong with that. But going back to what we were saying previously, we want to make sure that emergency fund is up and running and where it should be. And then we want to consider investing short term. Rule of thumb is there's a big difference between short-term investing and long-term investing. A lot of people will invest money in a brokerage or on Robinhood and put money in, and then they'll make a lot of money and they'll pull it out. There's nothing, I don't want to say that's bad, but we have to be considering the tax consequences of doing something like that. And the rule of thumb is that short-term, when we think about that 20% number, let me erase this real quick. We want to try to save 20% of what we're making. Each of these 4 buckets should get 5% of our income that's coming in monthly. So when it comes to investments, we don't want to just throw lump sums of money into an investment account. We want to make sure it matches the income we are making, and it matches our income we're making and our time horizon for the money. So personally, if somebody has a goal that's less than 2 years, I typically do not invest that money because that time horizon is very short. That's not to say you can't open a brokerage account on a certain platform, but we want to make sure that we're not putting money in and pulling it right back out of the market. That does not create long-term wealth. I'm going to talk about how we diversify and how we go about that. And then another topic, it's not really the topic of today, but it's important to know this, is that the 4th place that money can grow that is going to give us wealth for the future, but that is not in the stock market, is what we call permanent life insurance. So each of these 4 buckets, the traditional bucket, the Roth bucket, the investment bucket, and life insurance, all work together to give us money in the future, whether it's short-term, mid-term, or long-term, that we can pull out and use for a specific goal in our life. And I'm going to talk a little bit about the investment side, a couple things I go through with clients. How do we make sure we invest appropriately? And how do we make sure we're allocated the right way? So I'm going to talk about that. And those really apply to these 3 buckets right here. Anything in an IRA, anything in a 401k, and anything in a brokerage account or a stock account. Questions before I keep going? Everybody with me so far? Fix this.
Okay, looks good.
Okay, awesome. All right, so I want to think about, let me get this black box up here, just keeps getting in my way. Okay, let's do this first. So this is really important, and it doesn't matter if somebody opens up a brokerage account on their own, meaning they go to a platform like a Fidelity or a Vanguard. And I know that was a couple of the questions you all had. Where do I go if I just want to start investing? The best answer for you is Fidelity, Vanguard, and I would even say T. Rowe Price are some of the best platforms to just get started, whether you're opening an IRA, whether you're starting a brokerage account. The difference between, real quick, an IRA and a brokerage account you can put money into even if you don't have earned income right now. An IRA you can only contribute to if you have earned income. So that's a big difference between the two. So anybody that's setting up any type of investment account with me as an advisor, and anyone setting it up on Fidelity or Vanguard, you're going to go through a questionnaire like this. This is really important to understand. And this is what's called the investor profile. There are 11 questions that make up an investor profile to understand two things. What is somebody's time horizon, and what is somebody's risk tolerance? The word risk tolerance, I never used to know what that meant, but that means how comfortable you are with taking risk in the stock market. How comfortable are you putting money in, and how risky are you willing to be? So the first page of this investor profile, I'll also include this in the follow-up so you all can have a copy. And this is a good exercise to go through alongside the budget, is we have to understand the difference between the equity market and the fixed income market. And what that's referring to is it's looking at, in the equity market, that means stocks. Ownership in a company is going to be a little bit more risky for us than if we put money in fixed income. Fixed income means bonds. So bonds are safer than stocks. They just can't say that they're safe because both of them have market volatility. So as you guys can see on this graph of the return versus the risk, it's going to be safer or more conservative for somebody to invest in a portfolio that's more allocated in bonds or fixed income. So people who are nearing retirement or in retirement, and by nearing retirement, I mean like a few years away, they should be more conservative, or they should be more moderately invested, or of a half and half mix, sometimes a 60-40 mix. People like younger, in the younger generation, 20s, 30s, we need to be more on the aggressive scale, for the simple fact that when it comes to longer term investing, we need that runway to make sure we're getting the growth in a portfolio over X amount of years. If we were to set up a brokerage account and the time horizon was 5 to 10 years, that's a shorter term time horizon. You actually probably want to be more moderately invested. So that's the difference between equities and fixed income. So as we go through this, it will help you guys to understand how a portfolio gets set up and how it gets selected. Let's do this. All right, so on page 2, as I go through this with people, there are 11 questions that make this up. And I will send this to you guys. I'm not going to bore you with reading the questions, but as I go through this and as I answer these questions with clients, it gives us a score. So it's trying to understand, what does this person want from this asset or from this account? What do they want the money to do? How long are they planning to invest? And how long do they think they're going to be taking money out once they start taking money out? It's really, really important to understand that. So I go through all these different questions, and a couple of them are designed to understand, I know you guys can read here on question number 5, is if the market did go down or if the market went negative, what portfolio would you be comfortable owning knowing it could come back up? So if you guys read question number 5, it's trying to figure out, would you be okay with a portfolio going down negative 35%? Or could you only handle negative 14 or negative 7? That means that money dropped by that percentage. So we have to understand, even in a down market, the money will come back. We just have to be patient with that. So a lot of these questions are designed to figure out, what is our risk profile? So after I go through these and after I fill these all out, it gives us a score. Most people who are in their 20s, 30s, and 40s, and even into their 50s are scoring around the aggressive category if that money is in an IRA or if that money is in a 401k. And the reason why is because it's a long-term investment. People who are doing a brokerage account are scoring more in the balanced. I would really only say my clients in retirement, meaning they're 65 plus, are in this moderately conservative mix. And even some of them are more balanced because we have money other places. So we're not just hoping for money right there. So this really helps us to understand, how should the money be allocated or diversified. So if we keep going and we look at the different asset allocation models, this is really helpful to understand. And this is not just, I know I'm showing you this piece from Northwestern Mutual, but this piece is really, I look at all the different firms, then this piece is across the board very, very similar. So look at the difference if we zoom in here of a conservative portfolio, meaning we're 80% in bonds, versus, scroll out for a second, if we were looking at more of an aggressive or a very aggressive mix. In the very aggressive mix, we have a lot more asset classes that we're invested in. And in a moment, we're going to go through all the asset classes that we can invest in as investors, which is really cool to look at. So aggressive and very aggressive are giving us more exposure into some of these other sectors of the market, where we go up here, conservative and moderately conservative are giving us a little bit exposure, but we're still missing out on that growth in other categories. So say, for instance, I have somebody that scores up here and they score, I don't know, they score a 90. They're in the aggressive mix. So that's how my team and I know how to go tell them, we need to build a portfolio that matches this model right here. We need to go figure out what fund to go into to make sure that that money matches this allocation mix. And like I said, in a second, we're going to go through an asset class so we can understand what these categories and all these colors mean. The number one thing people do when they invest is they go into, I don't want to say one, but they go into about 2 to 4 of these colors, and there's 9 that we should be invested in. That's the biggest mistake people make when investing. They just go into one category of the market thinking, oh, well, I'm going to ride Tesla or I'm going to ride Peloton. And they're just going after one specific stock or company. All right, I'm going to break down here in a moment the colors on the sheet, what they are. Any questions before I keep going? Are we good so far? Here's to this. All right, so I'm going to pop this open, and I always make the joke that this a lot of times looks like the periodic table of elements. And it's not, because of course we're looking at the different categories of our stock market and what has happened between 2007 all the way up to last year. So I know this might be a little bit hard to read, but I'm going to go through this in a minute. We're going to talk about it left to right. And once you understand what's going on, it's a lot more easy to grasp and understand what these colors are, what is happening year after year after year. So the first thing to note is if we look here at the year 2007, that is really the beginning of the story to look between 2007 and 2009. I'm going to highlight that in a moment. And then of course, last year in 2021, that was a big indicator of what happened specifically in the real estate market. You can see it was up 45%, which is crazy because the year before it was down -11. So every class on here represents a sector of our stock market. I'm going to explain that in a second on page 2. But if I was to ask you guys if you were to see a pattern on here, or if you were to see anything that was happening, you might say to me, well, no, not really. And so the name of the game is to not be really riding the wave of being all the way up at the top or all the way down at the bottom. That is not what we want to try to accomplish. We more so want to stay along the middle. So if you were to find the white block, which says diversified portfolio, that is an asset class mix of all of the different categories into one portfolio. So it doesn't matter if it's a retirement account, it doesn't matter if it's a short-term account, it doesn't matter if you're putting money in here for a house or to buy a car or to fund education. The goal is to be diversified, so we're across the board. So follow this white block. And if we were to watch this, it doesn't really go all the way down to the bottom, or it doesn't really go all the way down to go all the way up to the top. It's staying here in the middle. And so on average, across that 15-year time frame, the diversified portfolio is giving us a compounded return on average of 6.3%. That's the return. And then we look at what is the riskiest place to put the money. So probably no shock, but diversified portfolio is the third least risky place to invest after cash and bonds, meaning cash and bonds are safe, and then comes our diversified portfolio. Probably no shock to you guys, real estate is at the very top of that list. That is the riskiest place to invest. So we think about over those years, diversified portfolio is giving us a pretty good return, yet it is not causing us a lot of risk on the risk frontier. So if we look at, for a second, between 2007 and 2009, this is where a lot of market volatility occurred. You guys probably have heard that term, market volatility. That means when stock markets are having a big rise and fall of what's going on. And probably last week or the past few weeks have been indicative of that. I have noticed a lot of volatility in people's accounts, just given the market in the past few weeks. So if we were to look at the red block, for example, get my thing here, and look at what happened, blow this up really quick so y'all can see it. If we were to look at between 2007 and 2009, what's happening is kind of crazy. So international emerging, we're going to talk about that in a minute, that was up 40%. Next year in 2008, it dropped and went down negative 53%, which is crazy. The following year, it went up 80%. So we have to think about that is when people make emotional decisions and when things happen with their money. So for example, in 2008, if a lot of these asset classes minus cash and bonds, I know you guys can see that, were down, people were getting scared and they were selling out of their investment. We're going to talk about what that means in a moment. They're losing the opportunity for that money to come back in 2009, which is really crazy. They just lost out on a lot of money. So the name of the game is to not cherry pick and pick a few of these different asset classes. It's to build a portfolio either with an advisor or on a platform by yourself where you're encompassed in all of these different categories, which is really helpful. So just think about, one, this is showing us what has happened since 2007, what is the highest return it has given, and then where's the riskiest place to put that money. That's what it's looking at. On page 2, we're going to look at what are these 9 different asset classes? What do they mean? What do they represent? And please stop me with questions. But this is really cool because every single year they come out with this from the previous year. So this one just came out to show us what happened in 2021. So it's really interesting to see that. And the best way to think about an asset class is to think about categories of our market. So it's looking at all the different places all of us as investors can put our dollar. So this right here is breaking down what are the 9. So I'm going to go through this and please stop with questions. So the first thing we look at is the top 3 are what we call domestic stock companies. And the 3 different categories that are US-based stock companies are large cap, mid cap, and small cap. So if I start with these 3, let me give you guys an example. This helps me to understand and explain to people what they are. So US large cap are in our economy, companies like Amazon, Coca-Cola, Pepsi, Google. You go anywhere in the world and they're going to know what a Coca-Cola is. You're going to find that probably anywhere you go. US mid-cap, I think about Harley Davidson. That's a big company here in the US, but it's not as big abroad. US small cap would be Under Armour when it first started about 15 years ago. They're more in the mid-cap space. I don't know if they're completely there yet, but they once first started as a small cap, meaning they could have made it like they have, or they could have fallen off the map and not become as established as they now are. The next 2 categories are highlighting the stock companies that were started internationally. So the 2 are international developed and international emerging. I think about international developed as a lot of the car companies. So Toyota, Lexus, Mercedes, a lot of those were not started in the US. International emerging, I think a lot about the fashion companies, makeup lines. There's some out there that are still up and coming. We don't quite know what they are yet. So they're either going to make it into the developed space or they're going to fall off the map and we won't find out what they are. Real estate is real estate. Commodities is anything like oil and gas prices and the price of coffee and soy. It's anything that is really a tangible thing in our economy. Fixed income down here, this blue box, is bonds. So you can have what's called a corporate bond, or you can have a government bond. And how a bond works is you put money into a bond and it pays you interest. And at the end of that bond term, you get your money back. So the term could be 3 years, could be 5 years, and the money comes back to you and you make interest along the way. And then cash just means cash. There's nothing fancy about that. It's very common to have a little bit of cash sitting in a portfolio to help itself rebalance. And if there's any investment fees to go to that firm or to go to that advisor, it comes out of the cash portion. So cash in a portfolio is very important and very common. And then, of course, like we talked about on page 1, diversified portfolio is a combination of all of the different 9 inside of one portfolio. What I find when I look at people's statements, whether it's a 401k statement or a brokerage or an IRA statement from a different company, what I'm finding, and clients actually point this out too, is a lot of times money is here in the large cap space. A lot of times it's here in the developed space. And then a lot of times there's a really small percentage in fixed income. So they're only in 3 different categories when they really should be in 9. I was doing a rollover this morning with a client and she sent me her statement. We went through the investor profile, we went through this together, and she looked at me and said, based on what we just went through, I'm missing out on a lot of these categories. She figured that out based on our conversations. So note to all of you would be, make sure you're well balanced and making sure that you're diversified in the right categories. Like I said, I'll share this with you guys so you have it as a reference point. Okay, I want to go on to a couple other investment pieces. We'll go back to the PowerPoint. We'll stop about 10 minutes for questions, but any questions right now, anything else you guys, or anything anybody's thinking about? Let's switch here. So 2 quick things I think that are really important to note. And I found this a few years, I guess this was in 2020 when this happened, but one thing to note when you go to invest, it doesn't really matter if we're talking about short term, we're talking about long term. The one thing that people make a decision on, usually it's an emotional decision, is when the market goes down. So when the market goes down and things right now are not where they once were, the price, of course, of Bitcoin has gone down, the price of people's just stocks have gone down, people make emotional decisions quickly. They do not wait it out and they do not let that money come back. So we look at over the span of 10 years, this is truly what happened, and we look at January of 07 all the way up to January of 2017. And we look at the example of 3 different investors. And this is when the recession hit between December of 07 up to June of 2009. So it was about, what was that? A year and a half of the market going down. So the first line, this dark blue line, is showing this person who started with an investment of $100,000 in January of 07, or right in December, I guess, of 07, or kicking that off. What happened when that person stayed the course and stayed invested in the market the entire time? They didn't pull their money out. They didn't change their strategy. At the end of the 10 years, their money, get my highlighter here, their money had doubled itself almost. So they started with 100 and 10 years later, and yes, that's really sticking the course, they had close to 200,000. That's investor number 1. Investor number 2, this orange line, they started at 100. And what happened is they got out of the market at the bottom of the crash. They got out in January of 09 and they got back in 1 year later. Even by doing that, they made money. They made almost 27,000, but they missed out on the difference, almost $30,000 of what happened between here. The blue line is somebody who got out of the market and went completely into cash. And what that means, because this almost happened to a lot of people in 2020 when the pandemic hit, is that they get out of the stock market and they go put their money into a CD, or they go and put their money into cash or a mutual fund. I'm sorry, not a mutual fund, a money market. And look what this person ended up with. They ended up with $55,000. So they lost half of their value. And the reason why is because they locked in the loss when it was occurring down at that bottom. And the thing I always share with people is two things. We can't time the market, and we have to make sure we invest early and we invest regularly and not make changes when things hit the bottom. Because investing is fun and it goes well when things are going well. It cannot be so fun when things aren't going well. We have to just stay the course and let it correct itself. Because as we can see, even though this bottomed out in January of 2009, 2 years later, in January of 2011, it came back to where it was 2 years prior to that. We just have to be a little bit patient. And a lot of you might think 2 years is a long time, and it is, but it's better than waiting and staying the course than pulling your money out and losing half of it. That's not an ideal thing. And I hear people say that to me a lot. They'll say, you don't want to hear this, but we pulled out at the crash and we lost half of that. We'll never make that back. And that's truly what happened and what happens when people do that. This is a good piece to know and to have. The second thing we're going to look at here in a second is how certain epidemics and pandemics and world events impact our stock market, which is kind of cool. Debbie, any questions from anybody so far? I think we're doing pretty good.
Not yet. Don't be shy. Put your questions in the chat, please.
Perfect. All right, so this piece I will also send. I thought that this was really, really helpful and really cool to understand. And all of us going through this the past 2 years can really understand how the S&P 500, or just what we were talking about, the large cap market. So what I was talking about, the Googles, the Pepsi, the Coca-Cola of the world, that is tracking the S&P 500. So if you look at the top, this is talking about events in our world, and then epidemics in our world that impacted the stock market. And what did it do the day of the event, 1 month later, 3 months later, and then you guys can read 1, 3, 5, 10 years later. So I thought this was really interesting that the one obviously we're still living in right now, and that's really impacting a lot of people, is coronavirus. And you can see the declaration of emergency was last January, 2 years ago, January 30th, 2020. And you can see 1 month later and 3 months later, the market went the furthest down. 1 year later, the market was up 15%, even following that event. So there's a lot of things that impact our economy and impact the markets, but you have to know things are going to bounce back. Even things like 9/11. You think about the day of the event, of course, the market went down, but actually a year later was probably the worst following that event. And then 5 years later, 10 years later, things have gotten, of course, a lot better in the markets year to date. So this is just important. I share this with people because events and epidemics happen. We just can't let that dictate the way we invest and the way that we pull out our money and what we're going to do with it. Alrighty, I'm going to hop back into the PowerPoint real quick, and then we'll wrap up from there. I believe that was all I wanted to go through on this. Do this really quick. Here we go. Okay, cool. So we went through the 60-20-20 rule. I know I'm hopping around, but I think those are really, really important pages to go over, and you guys can, I'll share them with you. I send those to everybody I probably speak to. Doesn't really matter where they are. They're just important to go through. We talked a little bit about this. Really, really important to establish that emergency fund early on to make sure that we have that 3 to 6 months of living expenses in an account. We talked a little bit about the power of starting early, and it's just really important to think about if you're saving for the long term, and we're not just thinking about short-term investing, we have to think about starting early and what that does for us, and we contribute X amount every month, every year, what that will do if our money is invested and if it's growing at a 6% rate. Just so you guys know, in the stock market, you can obviously have higher returns than this, but 6 to 8% in the stock market is a pretty standard return. So if you were to contribute $100 a month, and that's what you started with, that goes to show us what it would be worth in year 10, year 20, and year 30. We just contributed that much over time. You guys can read this, but this is really important to think about how long somebody will need money and how long that they will live. And we have to think about how to invest for our short-term, our midterm, and our long-term goals based on those factors. And so we talked a little bit about this on a previous slide, but here are some of the most common ways to save, invest, and have retirement accounts. And so the most of you, I would imagine, have the first one. You guys probably all have some type of savings or checking account, either at your bank or a credit union or something to that sort. I would encourage you, if you don't have a bank, a savings account and you only operate out of checking, I would definitely encourage you guys to set up some type of savings account or set up some type of, let me draw this out real quick, what we call high yield savings account. And if you've never heard of that, high yield savings accounts are the acronym for them are HYSAs. And what they're doing is they're growing your money in a safe place, but they're giving you interest every month. So you can also look at high yield savings accounts if you go onto NerdWallet, or you go onto, there's a couple different sites. I think Credit Karma has a couple good ones, and they'll show you the way that the money's going to grow. Bonds and mutual funds, we kind of just went over that, but you can invest in just bonds on a platform, or you can have a mutual fund that has stocks and bonds. And the word mutual fund, if I didn't explain this before, means it's a basket of different types of investments. It has stocks and bonds inside of this account. A 401k can be allocated very similar to a brokerage account. So a brokerage account and a 401k, they're different types of accounts, but you can have the same type of investment inside of it. And then an IRA, it can either be, like we said, a traditional, or it can be a Roth. These last ones have to be on your own. This has to be at work. This account has to be at work. So those are the different types of saving strategies, investment strategies, retirement options that we can have when it comes to putting money away. The one thing I would note is that this first one is definitely short-term. These would be more short to midterm, and then these two would be long-term. We have to think about the time horizon in which we need that money. We're not going to go over this real quick. Awesome. And then we talked about the power of the 60-20-20 rule. Here it is, just laid out a little bit nicer. 20% should go to saving and investing. 60% should go to our fixed expenses. 20% should go towards discretionary. Those things we don't need in our life, but we do them. And the thing to note too is when you guys do sign up for your 401k at your job that you get or wherever you go, you want to include in that 20% number, you really do want to include the contribution you're putting in and your company's match. So for example, if your company says we will match 100% up to 3%, that means that you should do 3% and they're also going to do 3%. So with that being said, you want to take 6% away from that 20 to know 14% should be saved elsewhere, whether it's a brokerage, your savings, or an outside IRA. That's a really helpful way to think about making sure you're not putting all of your eggs in one basket for just the retirement goal. A lot of people will max out their retirement, and that in theory sounds great when you're young, but you're tying up a ton of money that can't be accessed for a really long time. So we just want to be conscious of that. All right, cool. I'm not going to go through this. This is just talking about expenses. We talked about different goals have different time horizons. So you really need to get clear on why do you want to invest? What's it for? How long do you need it? And the answer should really not be, well, I'm going to invest and pull that money out in a year. That's not building a lot of financial security or building a lot of stability for that investment. So we just want to think about that. Here's some great questions to think about. How much risk are you willing to take with the money? We talked about risk tolerance. If you don't even know, or you don't know how you would be allocated, the investor profile I'm going to send over is a great exercise to go through. And if you did go on to Fidelity or Vanguard, there should be one on there too. I've gone on it with clients and I've seen them answer the same questions. Second thing to ask yourself is, how many years will you invest before you need the money? And that's your time horizon. Like I said, there is shorter term investing, but that's more do it yourself on a platform, where longer term investing is more 5 to 10 years. And then of course, 10 years plus. And then third is once you've reached the point where you want in the future, where you'll be taking the money out, you got to think about how long will you be taking the money out? Would it be one time? Would it be over time in years? So we just have to think about those three things. And then we talked about asset allocation. Do not put all of your money in one basket. A lot of times people just put money into the Googles or the Teslas of the world, and they're missing all these other asset classes that they could potentially invest in. And a lot of times in a 401k at work, we don't realize there's a lot else out there. So that's why it's a really, really good idea to work with an advisor and have an IRA or have a brokerage account, so you know that you're exposed to the different asset classes that are available to us. Cool. And then that's talking this is just talking about how do you protect yourself if something was to happen. And then this is just talking about back to the very beginning of making sure that you're doing the right things to give yourself financial security. Investing is one piece of it. We have to make sure there's other pieces that fall in line, such as our emergency fund, our budget, and just making sure you personally are saving and investing the right amount based on how much money you make. So whenever you think about yourself right now, whatever you're making right now, if you're working, or if you start working in a few months after graduation, you need to think about what your biweekly or your monthly take home is, and no more in the beginning than 5 to 10% of that should go into the market, because we need to make sure you're well versed on all different fronts. All right, cool. That is the end of that. Like I said before, I'm going to send everything over from today. I'll probably add in a couple pieces. I would encourage everybody, whether you're graduating right now or you're graduating in a year or so, I would encourage everybody to do the budget exercise, do the investor profile, and revisit them in 6 months or a year. Sometimes things change, and sometimes it's nice to go over that, but that is how you really help yourself build financial security. And then when you are ready and you are getting to a place where consistent income is coming in, you have a benefit package, you're looking at the 401k and other options, connect with an advisor, whether it's you look at an advisor, somebody you already know, or you reach out for recommendations. I'll obviously give Debbie my contact info. If I'm not the right fit for you, I can definitely connect you with somebody that might be, depending on just what your goals are and the demographic where you live and things like that. So it just helps to connect with somebody. The other thing I will share is not all advisors charge a fee. So that's really important to know. And some of this stuff is really confusing. So I and a lot of my other colleagues and a lot of my other partners, we are not fee-based. So the biggest misconception I hear from people are, do you charge a fee? And what does it cost to do this? To have a consultation and to just go through your goals and talk out loud about financial planning, I don't charge for that, and a lot of my colleagues don't either. That's not fair to just be able to help somebody. So that's number one. Don't think that all advisors charge a fee, and that's a lot of times the reason why somebody doesn't connect. And then the other thing is, you don't have to have a lump sum of assets or a lump sum of money or make a certain income threshold to speak to an advisor. A lot of the advisors that I coach that are starting out, that I'm helping to build their practice, and myself included, they're all open to working with anybody, even if they're just graduating or they're right in their first year of working post-grad school or college. So you do not have to have a certain amount of income or assets to invest to speak to someone like us. And it's just helpful to have somebody to turn to. So I will leave you with that. Debbie, I think you were trying to come on. I'm sorry.
Oh no, you're doing great. So
okay, cool. I'm reading some of the questions.
Right, and I know I have some questions from some grad students upon registration. So a lot of students are living on stipends, and money is very, very tight. What is your advice to them if someone is trying to grow their money on a very limited income?
Yeah, that's a good question. So first things first, and anybody can interject if this does not help, but first things first, you got to cover your basic expenses. That is number one. And I would say, and I tell people, because I have a lot of clients that we'll connect, and they'll be living on a stipend, or they work for a nonprofit, or there's not a lot of money coming in, and we'll just have an informative talk where we kind of just bounce ideas off of each other. And I'll say, look, you've got to cover your fixed bills, you've got to pay X, Y, and Z, because there's really no way around that. Anything you're able to save from your paycheck, even if it's 5% or 10% or anything you're able to put away, and I mean it, even if it's $25 a pay, or even if that's for the month, that's more impactful than doing nothing. So I think, to answer that question, sometimes it is tough, because when you're living off a stipend, there's really not much left over. I would say put away anything you can, and just be really conscious of the expenses in your world that really could get cut back. And you guys probably know this, but people have the craziest expenses that could really get cut out, and you can find money somewhere to go and save, whether it's, not everybody wants to hear this, but whether it's cutting a subscription like Hulu or Netflix or Spotify. Yes, those are wants, but we can always find extra money if we're paying for things. The other thing I would say is, along that topic, is if somebody has things they have to pay for, taking out a credit card to pay for certain things at a 0% rate and getting 0% credit for 12 months or 18 months is a great way to free up money and utilize it from the credit card company that's free, so you can go and put money somewhere else and grow it more efficiently. People have this big stigma on credit cards that they're bad. They're only bad if we're not responsible and we don't pay them off. So using someone else's money at 0% and being responsible with it is more effective, because then you can go take that money and free some things up and go invest it in the stock market, or just put it in cash and get a better rate of return than 0%. That's what I think about. I don't know if that's helpful, but that's literally how I talk to clients.
No, that sounds great. Makes sense.
Cool. I think Rihanna, did I answer your question? I think you were asking me about advising services cost. I hope I answered that. Perfect. She said yes. Yeah, and just think that not all advisors work like that. I'm with Northwestern Mutual, but I was sharing with Debbie, I'm also a broker, so I can broker out insurance and investments, but it's my decision to not charge people a fee, or to not have a consultation and charge them for my advice or my time. I only get compensated when a client moves forward with recommendations, and many times they do, but that is to encourage people to have these conversations early on and make sure they're thinking about these things before it's too late. So yeah, not everybody works like that, but it's helpful to know those two things. We don't all charge a fee, and you don't have to have a certain amount of money or income level to talk to somebody. And like I said, I've been doing this 6 years, and it just breaks my heart the amount of times I hear that.
All right.
Awesome.
Any other questions? All right. Well, Rachel, I know you're going to send me the slides and the handouts. It's just fascinating to see it on paper, how different types of investments react and rebound over time. And,
yeah,
and just
it's crazy.
What you said, that you've got to diversify and just stick with it through the ups and downs.
Isn't that crazy? Let me share my contact info in here. I'm going to share with you guys my email address, so feel free to email me at any point in time. Also, I'm pretty sure if you Google Rachel Sy, Northwestern Mutual, you can connect with me via my client website. A lot of people put in information if they want to connect and set up an appointment. You can get my phone number, my email on there, and that's the easiest way for it to come to me. And like I said, I can connect with you. I can connect you with any other advisor if you live in a different area. I know you guys go to Maryland, but if you live somewhere else, I can always connect with anybody across the country, or I can just talk to you directly. So there is my email if anybody wants to save that. And then I will email Debbie all the documents we went over today.
Yeah. All right, last call for questions. All right, seeing none, let's wrap this up. Rachel, wow. I've been investing for a long time now, and you just did a great job of covering it all.
good.
I have a lot of questions still, but it was very thought-provoking. So thank you so much for your time. I appreciate you so much, and it's fun to see, what you can do with your money. So
no, it's very cool. So thank you all for your time. And Debbie, thank you for having me. I appreciate that.
You're welcome.
I will email you later today with everything we went over. And if anybody wants to see anything else that wasn't included, just let me know.
All right. So thank you to everyone also who joined us synchronously on Zoom, and those who are going to be watching this on YouTube. Please remember to fill out that quick survey, and you can register now for the next workshop, which is next Tuesday on buying your first home. So happy February to all of you, and let us know how the staff at Legal Aid can help you. Bye.
Bye.